Welcome back. It's time for Stock Picks. Today we are serving up the food producers as Premier stirs up the sector with its planned merger with RFG, AVI proving its resilience in a tough economy, and Tiger Brands streamlining its portfolio. And joining us to unpack their performance is Culverwell from Anchor Capital. Sean, thanks so much for your time this afternoon. Maybe before we get into the individual stocks, let's get your insights on what you've made of activity in the space, right? There's been a lot of shifts, as mentioned. We've seen Tiger Brands streamlining its portfolio, and of course the M&A activity playing out there as well.
Yeah, I think the industry was ripe for some consolidation, and there have been rumors circling for some time about some consolidation.
Yeah.
Those rumors were initially ignited when the CEO of Tiger, Tyson Foods US, was spotted flying in on his private jet. Everyone assuming that he was coming to do some shopping, but seemingly not. But a lot of the businesses have too broad portfolios, and that need to be trimmed down and, fit for purpose, and the consolidation does some of that work for them. So long overdue, and not surprising that we saw this Premier and RFG tie-up.
And you spoke about, these companies streamlining, and we've been seeing that really at Tiger Brands, with the company really rejigging its portfolio, ditching what works, what doesn't work, and keeping what works. What have you made of, the streamlining of the portfolio, as well as the turnaround progress as a whole?
Yeah, so I think for far too long, Tiger's SKU count was too bloated. They also had a collection of businesses that didn't really fit together. And then, led by Chart Kruger, the new management team came in and really has turned the business around, trimmed off those non-core businesses that we spoke to. So now the organization is a lot leaner, fit for purpose, and focused in terms of the products that they want to excel in. Now, I would say that they had an excellent last year, but I would say everything that they've been doing up to this point is setting the path for growth.
Yeah.
And now going forward, they can really crack on and stimulate some good growth in those core categories.
And given, rising competition in that industry, as well as, the private labels also coming in strong, how strong is Tiger Brands' brand equity across its flagship categories like cereals and canned foods, right? Also, just considering that consumers are cash conscious and likely will go for a cheaper product in categories.
I would say that their core brands do garner a sense of brand loyalty within the South African market. But there was sort of affiliated brands that they had within their portfolios where they didn't have that brand equity, and that's really where they needed to trim off.
Okay.
And they've done that so far, and it's worked out for them.
All right, let's move over to AVI then. Let's start off with price dynamics on that front, and maybe how sustainable AVI's pricing power across its core brands is, given the current squeeze, of course, on local consumer spending. And we just mentioned the growth we've been seeing when it comes to those private labels. The private labels that have been gaining traction. How has AVI been faring when it comes to that?
So AVI is very much protect margin now, worry about market share later. So
Yeah.
Simon Crutchley and his team will protect their margin with everything that they are. And you saw that with the recent ramp in input cost inflation in tea, palm oil, and coffee prices. Obviously, that has a big bearing on enticed beverages. So you've seen pricing there over the last 3 years being hiked in some years 12, 13%. What that has done is you've seen a drop back in their volumes because consumers just haven't been able to keep up, but they have protected their margins. Having said that, those raw material prices in those two, in enticed beverages and also Snackworks, have come back. So you should see pricing normalize going forward. And then they've also introduced some effective product innovation to bring in price points for the lower end consumer, which should benefit as well. Because some of the lower end consumers, they really want to participate with some of AVI's brands, but they just can't afford it. But now AVI with pricing normalizing and then some innovation, hopefully we can see an uptick in volumes.
And AVI also an interesting one because it's really a mix of, the food products as well as personal care brands. How are you viewing this diversification? Is it a strength, particularly when looking at what other its peers are doing? We just spoke about Tiger Brands really streamlining its portfolio and keeping what works and losing what doesn't.
It's similar to Woolworths, where investors would love to have Woolworths food in its isolation and not have Country Road attached. It's the same with AVI. Investors would love to have Entice Beverages and Snackworks without the fashion and personal care businesses. But management believe that it is part of a diversification strategy, and they still believe in those businesses. Another factor you have to remember with AVI is I&J. Now, I&J used to be a big profit contributor for the business, but it has really underperformed over the last couple of years. But funnily enough, that business finds itself in the ideal environment at the moment. So you've seen an improvement in hake catch rates due to the La Nina conditions. You've also got a stronger rand, which benefits them very nicely because they export a lot of product. And then you've also seen fuel prices remain very low, which is the main input cost for them with their shipping vessels. So at a time where personal care and fashion may struggle, you may have a business like I&J that really comes through and boosts earnings for the year ahead.
And let's move over to the last pick, which is Premier making headlines last week. Of course, we touched on it, that bid to acquire RFG. Maybe let's get into the rationale behind it, digging deeper into it, and whether those businesses do overlap or actually will form a perfect partnership.
So before getting into the deal, I'd just like to say that, Premier really have established themselves as the ShopRite of milling and baking. They've carved out dominant market share in the coastal regions, and then through best-in-class manufacturing, they generate the best margins in the industry. The issue with the Premier investment case is the liquidity profile of the company, and then the concentration in earnings to that mill-bake segment. Obviously, this roads tie-up boosts those two roadblocks to the investment case. So with the issuance of shares, the free float will increase. But then also with the consolidation of Rhodes' food business, you don't have such concentration in earnings in milling and baking, which makes a lot of sense. But I think in terms of competition commission, there's no overlap between the two product portfolios, so that would be very positive there. But they do sell to the same customers, so they can extract some very strong cost efficiencies in their distribution channels. So for me, I think it's a great tie-up. Maybe it's taken a bit too long, but certainly both shareholders win in this situation.
And how are you viewing Premier's rate, or rather its ability, Sean, to sustain double-digit earnings growth? Of course, you mentioned there, the reliance on categories like bread and maize.
So just speaking to the acquisition, how that's going to impact their earnings, obviously long stop date is only September next year, but it could be done by March next year. So the consolidation of Rhodes' financials will only come in probably FY27.
Okay.
But Premier are acquiring them on a, Premier are rated on a 14 times earnings, Rhodes are on a 9 times earning. So immediately when you consolidate Rhodes, there will be an uplift to earnings. But in Premier's core business, we are expecting a moderation in revenue, just given commodity prices have pulled back. So naturally, Premier's pricing will pull back, but we're still expecting a big uplift in margins, which should keep that earnings growth coming through. Also, what they have in the second half of this year is they commissioning their Aeroton bakery, and that will see another uptick in margins. So revenue is going to be relatively steady, but we expect more margin uptick, and then they're also paying off their debt steadily, so you'll have a drop in financing costs, which should keep earnings growth growing at a healthy clip.
All right, let's leave it there. Sean, thanks so much for your time and your insights on that sector. Now, that was Sean Culverwell from Anchor Capital.